Hey everybody, this is Ryan Mallon. We're going to do a stock market update for you guys here. The S&P 500, it was down on the week. The Nasdaq was up on the week. And then you had the Russell that was down on the week. The S&P 500 has now dropped 4 weeks in a row, while the Nasdaq has broken a 3-week losing streak. So what's going to happen here? We have a little bit of a mixed picture on the stock market. Are we starting to bounce here? Or are we going to continue the sell-off in the days and weeks ahead, especially leading up to the election? I'm going to get into all of that and more in this video. There's a lot of reason to believe that after a continued sell-off that we haven't seen since March, that we're setting up for a bounce play. I'm leaning more towards the fact that with the Nasdaq leading this past week, finishing green, that the other indices like the S&P 500 and the Russell will start to follow suit as well next week. There's still a lot of question marks. Anything can happen, but if you look at what the price action was this past week, the price action overall, it would tell you that with prices generally oversold, we're looking at a bounce going into the week ahead. But like with any assumption or analysis that I do, I could be wrong. As a result, that's why you have to manage the risk. That's why you have to use stop losses, because if you don't, when you're wrong, you end up staying wrong for far longer than you want. Instead, risk management and stop losses allow you to be wrong briefly and then to get back on the right side of the market. Let's go ahead and get into these charts here, see what they're showing us right now, and see what we can expect next week. First off, on the S&P 500 daily chart, you have an oversold market here. It's been sitting here in oversold conditions going all the way back to the beginning of September. It's ripe for a bounce. Like I said earlier in this video, we are currently 8% off of the all-time highs established earlier this month. That makes for a pretty bad sell-off for the month of September. As a result, it has pulled back perfectly to this breakout level going back to late February. It has tested it multiple times in the past, and now it is trying to hold that support level and bounce higher. So even though the S&P 500 finished lower this past week, it actually sets up good for a dead cat bounce at the very least in the week ahead. While we have this bounce opportunity, there's also this lingering head and shoulders pattern that I've talked about in previous videos, and I've also said in those videos, these head and shoulders patterns going back about 2009, from my observations, they are oftentimes a way to sucker in the shorts and then to squeeze them higher. We saw a little bit of that Thursday and Friday as this head and shoulders pattern was playing out. It sucked in the shorts and then they rallied on Thursday and Friday. So watch this breakout pattern, watch the head and shoulders pattern. One of them is going to win out, and that's the side that you want to be on. On the weekly chart of the S&P 500, you have 4 straight weeks of selling. That doesn't happen very much. In fact, the last time it happened was August of 2019. It's not something that happens a lot, but that's the past. What we're looking at in the future, and that is, will it drop for a 5th straight week? You have to go all the way back to 2011, May of 2011, to find a time where we dropped 5 straight weeks. In fact, in 2008, when we had the Great Recession, there was only one time where it actually dropped more than 4 weeks in a row. It had a period of where it dropped 6 straight weeks. So it hardly ever happened. So you're looking at an event that's happened twice over the last 12 years. So then the question becomes, are we looking at something going into next week that's going to happen again for a 3rd time in the last 12 years? I'm going to say, just based off of the odds, based off of the support that we're sitting on, that's not likely to happen. But if it does, you use a stop loss. You get out of the trade. You don't stay wrong. Get back on the right side of the trade. On the monthly chart of the S&P 500, you're looking at a 5-month winning streak that's going to be broken at the end of this month unless we have this like heavenly rally that takes us back into positive territory. Not likely, considering the fact that there is only 3 trading sessions left of the month. It would have to make a miraculous rally. Also, it's worth pointing out that when you get these kinds of candles, it usually leads to a significant sell-off as well the following month. And we have the perfect situation with that. We have a lot of uncertainty here in the United States with the 2020 elections. There's a potential to see a lot of volatility seep into the market starting next month. And with it being the end of the quarter, oftentimes you see a lot of window dressing. So with us selling off the last 4 weeks, I would not be surprised to see a little bit of window dressing where the funds want to start getting long on the market again going into the end of quarter. Just because we have a rally next week, if we're to have a rally next week, doesn't mean that continues for the weeks that follow. There's still a lot of bearishness out there. There's a lot of reason for investors to start taking profits, especially with the uncertainty of the 2020 election. And with almost every big candle that we have seen over the years, it's usually not the last one that we'll see in the coming months. Check out the Nasdaq daily here. It is really a messy chart. You still have the head and shoulders pattern, and like I talked about in the S&P 500, it confirmed just enough to get a lot of shorts in and then to squeeze them back up. We have a lot of consolidation over the last 7 days, and prior to that 7 days, you had even more consolidation before it took that initial push lower. So there's a lot of choppiness in this index right now. But while the head and shoulders confirmed earlier this week, it didn't last long. It's back above the neckline. And you're going to want to watch next week, how does price action act around the 50-day moving average? You've seen a lot of rejection over the last 7 days regarding this 50-day moving average. So if it can break back above it and it's coming out of oversold conditions, we should see tech take a big push next week. Weekly, it snapped a 3-week losing streak. So it's actually ahead of the S&P 500 here. It's leading the market higher at this very moment. You could even make a case that it's almost like a little bit of a bull flag pattern that has formed on the Nasdaq. That doesn't mean we're going straight up to all-time highs anytime soon, but it does set up for a nice rally next week. Also worth noting is the fact that we have a bullish piercing pattern on the weekly chart. Now, what a bullish piercing pattern is when price opens below the previous week's lows, and then it recovers, finishes green, and takes out 50% of the previous candle's body. So it did that. It finished 50% above the previous candle body, and it formed a bullish piercing pattern. So that's good going into next week. That's another positive to look at here. Just like we have a bullish piercing pattern on the weekly chart, we now have a bearish piercing pattern on the monthly chart. And this bearish pattern is the exact opposite of what I highlighted on the weekly chart, in the sense that it opens above the previous candle pattern's highs, and then it covers more than 50% of the previous candle's body, and it's done that here. In fact, last week we talked about a bearish engulfing candle pattern, and that still may happen, but for now it's a bearish piercing pattern. And remember what I said, huge sell-offs are not just flash in the pans. They usually seep into the following month. As a result, I'm not overly optimistic that we're going to see a major rally out of the stock market in the month of October, but in terms of next week, I think we're setting up pretty good for a dead cat bounce. Now, before I get any further, make sure you check out my channel membership here with YouTube. You just click on join below. It's going to give you all the options. It's going to give you the opportunity to get so much more information that goes beyond my 2 videos that I do every week. What you're going to get is you're going to get additional market analysis each week in the community tab of my channel. You're going to get charts for the S&P 500, the Nasdaq, and the Russell. You're also going to have the option to be able to get my FANG updates. That includes Facebook, Amazon, Apple, Netflix, Google. In addition to that, you're going to get Microsoft and Tesla. These are all on top of the videos that I already provide you with. And finally, you can have my personal watch lists, the stocks that I'm following updated twice a week, and all the charts that I'm finding interesting or could be providing some nice trade setups. So check it out down below, click join. If you have any questions, just reach out to me in the comments below. So check out this Russell chart here. It's a lot different than what we've seen out of the S&P 500 and the Nasdaq. It is marching to a completely different drummer. Main reason why is it doesn't have the FANG stocks in it. It doesn't have the presence of these very large companies influencing its overall price action. Because let's be frank, much of the recovery off of the March lows has been because of large tech stocks. So you take those out of the picture, or you just take out all the large caps in general, which none of them are in for the Russell, you don't have as good of a picture with the Russell as you do with the S&P 500 and Nasdaq. Nonetheless, you have a declining trend line that it can't break. It is still yet to make new all-time highs like the Nasdaq did eons ago and the S&P 500 did. It's sitting below key support here with a double top confirmed. And yes, while I still think that if the S&P 500 can rally and the Nasdaq can rally, there's a good chance that the Russell will as well. But one of the things that we have to be cautious of here is that it may lag if the tech is the leader next week, because more times than not, when the tech rallies really hard, the Russell pulls back some or lags the overall price action, and vice versa. So when it comes to plays next week, I'm going to focus on your large cap stock, not the small caps. The weekly, it's still getting chopped up in this price range here that it's been stuck in for the better part of about 6 or 7 weeks. And the sell-off in the Russell has been going on for about 6 weeks now, whereas what you've seen in the Nasdaq and the S&P 500, it's only been for about 4 weeks. Now, we talked about the double top on the daily chart of the Russell. We have an even bigger double top on the monthly chart, and it's confirmed as well. It had a huge washout with the February-March sell-off, and now it looks like a dead cat bounce with the September sell-off. It's looking to resume that downtrend and maybe even test those March lows again. There's still a lot of risk in the market. Yes, I'm optimistic that we're going to see a bounce next week. If we don't, use the stop losses, you get out of the trade. The one thing you got to remember in trading, there is no room for ego. If you're wrong, you're wrong. You move on to the next trade. You manage the risk in the process. But a lot of people, and I've been getting a lot of comments about this, are talking about the airline stocks. They're looking at some of the beaten down companies like Boeing, like American Airlines, like your cruise line stocks. If we're in the midst of a significant pullback, and anytime you pull back 10%, that's pretty significant. Why would you want to look at the stocks that pretty much suck? They sucked when the market sold off really bad, and when they bottomed, they didn't really rally with the market. So why would I start targeting those trades instead of like Apple, instead of like Google, instead of Nvidia, the ones that have pulled back because the market pulled back? But if the market's going to rally, these things are going to be out front leading the way higher. So I want to avoid the bad companies. I don't want to get into cruise lines, casinos. I don't want to get into any of those. But what I want to do is get into big tech. I want to get into some discretionary stocks and some industrial plays as well, while avoiding energy plays, avoiding the travel plays, and other stocks that just really haven't rebounded with the overall market. And that probably includes financials as well. They have lagged the overall price action, as have the utilities. So look for the good stocks that have pulled back. Don't go after the crappy stuff. And if this market's to bounce next week, those stocks should be just fine. If you enjoyed this video, I ask you to smash this like button down below. Also, make sure to subscribe to the channel. You get notifications every time I do one of these posts. I do about 2 a week. I want to make sure that you guys are staying in the know, that you guys are staying responsible as traders, managing the risk, and I'm going to tell you how I do it each and every week, so make sure that you subscribe down below. Thank you guys. Oh, and let me know down in the comments, hey, what are you doing in this upcoming week? Are you optimistic on a market bounce next week, or you just think it's just going to be gloom and doom? We're going to do something that we haven't seen in about 10 years, and that's sell off for a 5th straight week. Let me know in the comments below. Thank you guys, and God bless.